risk graph is a vital tool in establishing the reward-risk profile of an options position. A trader who simply buys a stock outright can easily calculate profit and loss solely based on price. For example, if you purchase IBM at $190 per share and sell it at $195, your profit is $5 whether you sell it today or 2 weeks from now. However, since option prices take into account a number of factors such as volatility and time, and both of these affect the option price, there is not a quick way to forecast potential reward and risk on the position. However, the risk graph can quickly make these calculations for you. In the upper left-hand corner of the risk graph is the symbol as well as the real-time last and net change, historical volatility over various periods, and the cumulative implied volatility for both calls and puts. In the spread selection area, you can choose from over 30 pre-selected spreads sorted by market sentiment. Or you can build your own spread by left-clicking on the Edit Spread button and manually adding the option or stock leg along with quantity you wish to model. In addition, you can also choose a custom price to model a trade that you've already taken. There are two axes on the graph. The right axis is the profit and loss, and the lower axis represents the underlying price of the stock. In the case of this long call position, as the underlying price increases, the model lines move to the upper right into the green shaded area, which indicates profits in the trade. If the underlying price goes down, the model lines will move into the red shaded area of the graph, indicating a loss. By default, two models will be shown. The solid blue line, which represents profit and loss at expiration, in this case September 20th, and the dashed line, which represents profits and losses on the current date. The vertical dashed white crosshair aligns with the last price of the stock updated in real time. At the current price, the trade is break even today and would have a full loss on expiration day. To project a profit or loss, move the cursor to the targeted underlying price and the crosshair up with the model lines. In this case, a move of $195 on option expiration day would result in a $245 profit, and the same move today would net a $322 profit. The purple bars represent a 1 standard deviation price range at expiration. This can be adjusted to a custom value by left-clicking on the probability expiration button on the right. Also notice the shading of the background. The black background represents the 1 standard deviation price range, and as I move the scale of the chart, notice the second and third standard deviation areas being added in the price axis at the bottom of your risk graph. You can add a chart to your risk graph by clicking on the chart button in the lower right-hand corner. This adds a chart next to the risk graph and matches the scale of the risk graph to the chart of IBM. On the far right, you'll see a trade summary screen. This includes break-even prices, max risk, max profits, as well as the debit or credit associated with the trade. You can also model the Greeks or spread value of the trade by adding a separate pane to the risk graph from the right-click menu. In this case, I've added delta, and we can now see the projected delta based on the two models. Below the risk graph are the models that allow you to adjust days to expiration and volatility changes. The solid line is based on the day of expiration. If you'd like to see what profit or loss would be 2 weeks from now, we can either slide the date adjustment bar or select the date from the calendar dropdown. In this case, I'll move the date adjustment bar to August 29th. As I move the bar, you can see the days to expiration on the right decreasing. We are now 22 days to expiration, and you can see the dashed line on the risk graph has adjusted to this new date. We can also change the volatility by choosing from one of the pre-selected volatilities, historical and implied, changing the value to a manual number, or adjusting the slider bar on the right. As you can see, as I adjust the volatility higher, the profit and loss line adjusts to the new volatility. Additional models can be added by placing a check mark next to one of the unused line styles. If you would like to compare this particular trade with another type of spread or another option, click on the Compare Spreads button. This will give you the ability to add a second trade to the risk graph. By clicking on the Spread button, I'll add a long straddle. You can now see both trades represented on the risk graph, the blue being the long call and the orange being the long straddle. Also note that on the right-hand side of the screen, the long straddle is added to the trade summary along with the break-even, max risk, and max profit for that trade. As I adjust the models below the risk graph, both trades will adjust to any date and volatility changes. I can add additional spreads by clicking on the Add Spread button. In this case, I'll add the short iron condor. Notice that only 2 spreads appear simultaneously. To choose the spread, simply click the check mark in the upper left-hand corner of the spread that you want displayed. In this case, the iron condor, and now the long straddle.